Hello and welcome back to Coinscrum's Meet the Founders. I'm thrilled to be joined today by Jonathan DeCarteret, our CEO, and Gareth Ward, who's COO at Bumper. Welcome, guys.
Great, thank you for having us.
Hi, thanks for having us, yeah.
Not a problem. Looking forward to hearing all about Bumper. But before we do dive into that, we'd like to hear a little bit about our founders' backgrounds, what they were doing before they got into the crypto and blockchain industry, and how they got into this space. Jonathan, perhaps we'll start with you.
Yeah, sure. Well, I graduated with a degree in artificial intelligence, and I've spent the interim period of my life really starting, growing, and then exiting a succession of businesses. Most notable to that was a company called Switch, which I grew to the UK's 60th fastest growing company. And I've kind of been on this trajectory, I suppose, of kind of starting with companies that were more in the kind of creative sector, then moving more into tech-based businesses, then fintech, kind of crowdfunding sites, and then eventually kind of uncovered cryptocurrencies in kind of 2016, 2017, and it's just been a one-way ticket ever since.
Yep, as it has been for many people.
Yeah.
Gareth, what about you?
Yeah, well, I've been in creative industries for the majority of my working life, and in kind of creative and technical roles, and owned a couple of businesses through that time, and a bit similar in that, kind of the crypto call came along, and it was just a complete shift. Everything became crypto, and that's kind of about a year into that, Jonathan and myself met, and came up with this idea, and kind of moved and created Index.
Great. So yeah, Bumper's not your first project. I think your first project together, as you just mentioned, Index. Can you just tell us a little bit about that, and maybe about some of the lessons you learned while you were kind of going through that particular journey as well?
Yeah, gosh, lots of lessons for sure. I think the kind of genesis of that is that Gareth and I kind of found each other as two traders of cryptocurrency in kind of 2017, right? So that kind of really massive expansion period where crypto, I think, started to become mainstream for the very first time, and the ICO craze was in full burn, and we were trying to kind of understand where the revenue profit opportunities were for us as individuals within that. And I think anyone in that period was just started to kind of suffer a little bit of emotional exhaustion that comes with the volatility of crypto. And I think we just turned to each other one day and just said, is there a way that we can find some emerging assets within crypto that will give us more of a passive income as opposed to this kind of wild roller coaster ride, just so we can kind of have a bit more of a diversified portfolio. And Gareth being Gareth, who's always, as far as I'm concerned, right on that bleeding edge of crypto, and is always just interested in, where's the next rabbit hole that I can jump down to kind of understand where the next kind of nexus of breakthrough is going to be. Kind of put masternodes on our radar as this quite interesting asset that you can basically acquire, generate an income from. And Index was born out of creating an index of these passive income, yield-bearing assets that we could assemble into a basket that would allow you just to kind of hold those and earn a passive income from. So that kind of summed it up, Gareth, or was there anything?
Yeah, I mean, that was pretty much it. That's how it kind of evolved, and that was just a whirlwind. And like you kind of implied, the lessons, not just in crypto, but in business as well, that with every business is unique. And Jonathan's got a great track history of starting and exiting many businesses, and very good at it. But it was very unique issues, and that came from everything from managing community, the technical challenges, the regulation issues. It was just a constant bombardment of fighting fires for 3 years.
Mm. Yeah. And I mean, I guess that was, it's obviously become far more relevant and prevalent now, the idea of, passive income around crypto. And those were the early days of the first kind of sort of proof of stake models and proof of stake networks. And obviously with Ethereum moving in that direction, and with the explosion of DeFi and different ways of generating passive income and yield from the assets you're holding, I guess, this idea from, as you said, in the early days, 2017, and I guess even in the last year, there's always going to be the people that, love that roller coaster ride and want to take on that risk and want to see those kind of huge gyrations in prices. But as more sophisticated investors and traders come into the market, they kind of temper their expectations a little bit and maybe want to manage their risk a little bit more. So I guess that leads us on to Bumper. And I guess from my reading and research in advance, maybe describe Bumper as a socialized and liquid options market, which with the objective of taking the complexity of trading options away from the end users to offer them protections in the DeFi market. Is that a good explanation or summary of Bumper?
I think that's an excellent summary. The kind of context for us, right, was we were back in 2020, and for Gareth and I, we started to see the emergence of DeFi meaningfully. And for us, this was the whole purpose we got into crypto, right? The notion where money is programmable, it can exist in an ecosystem with no counterparty risk, that you could structure, kind of financial instruments and structured products in a super efficient way, was really the reason that we got into crypto in the first place. And we managed to convince the stakeholders in the business that we really should be focusing on this area. This is where the value is going to be. And then Gareth and I kind of sat down through a really long process of just saying, well, where is the opportunities? Once now we've got the emergence of this ecosystem, you can start to kind of see where it's going to go. It was possible to, bombard yourself by reading 15, 20 white papers a day, trying to kind of understand, the kind of context to what this ecosystem was capable of. And something that we were just naturally drawn to was just to say, well, is there a way that DeFi can fix the holy grail problem of volatility, right? And we came up with a concept of an idea that we felt that if we could get some kind of engineering minds on there, some architectural minds on there, might just be a new way to allow yourself to protect yourself against volatility, because that's always been a real bugbear for us. It's like, well, really your options are options desks if you want to protect yourself, or you go to take a stop loss, or you're just trying to kind of hedge yourself with another asset class that might be contrary to the one that you're kind of investing in. None of those are particularly accessible. They're not clear and easy to use. They're not particularly efficient as a kind of cost efficient way. And what we happened upon in Bumper was a true and honest market that takes that asset price risk, smashes it with a sledgehammer into a million pieces, distributes that risk among pooled liquidity, surrounds it all with cascading mechanisms, and backstops it with a potential reserve. The net result of that is a bulletproof protocol that can deal with any volatility that crypto can throw at it.
Mm-hmm. Well, I guess that's a natural progression from what we've seen in the markets over the last year, with decentralized exchanges, the idea of automated market makers. These are all functions which are, you spoke about programmable money and everything. Are we moving into a world where all of these functions can be programmed? Market making functions have been around and services provided in traditional markets for many years. Now with decentralized exchanges, whoever you are, I guess taking into account possible issues around fees currently, but hopefully that will be addressed in the future, that anyone can participate, and it's as simple as literally sending funds to a contract. Whereas in traditional markets, the average man in the street can't necessarily do that, can't participate in that mechanism. So Gareth, maybe it's time to dive into the weeds a little bit more about Bumper and look at how the protocol is designed, and touch on kind of various the various elements from kind of the participants, the makers' view, the takers' view, and maybe step us through that.
Yeah, sure. So I think the first thing to kind of establish or kind of dive into the kind of more technical schematic is, if you take the simple concept of Bumper, where you protect the price and you set that price floor, could be $1,000, for example. when the asset drops below that $1,000, if you were to swap out of it into a stable coin, protect it, let it drop back further, and then come back up. When it comes back up the floor, then you go back into that asset, and then basically you've kind of protected. But what happens is when it starts oscillating across that floor, you have a huge amount of slippage, a lot of trading fees, transaction costs, gas fees, and the slippage is basically, we modeled it, and the more reactive you are, when I say that, instead of if you were to just let it make a decision once a day versus, you know, every minute, it actually becomes completely untenable as a kind of concept to do that at a kind of minute level, even tick level. So what we really walked into this was, okay, there's fundamental, how can we solve for that slippage and match what we're trying to do here? And what came out of that was a far greater kind of platform, and that's Bumper. So when you look at this schematic, and I'll kind of take this through quite quickly because there's a lot to it, but you have two parts of the actual of the protocol. So you have an unstable asset pool, for example, ETH, and then you have a stable reserve pool, which is like USDC. There'll be many more stable coins, there'll be many more assets, but these are our kind of launch assets. You then have what's called takers of they're the ones who take out a protection policy. They put in their ETH, for example, they get a representative token back, they pay fees. The fees head straight to the makers, who are the liquidity providers that deposit stable coins, and they earn yield. They earn yield in two different ways. They earn the premiums from the takers, minus a bit of protocol admin treasury fees. And then they also earn from the money in the reserve. A large proportion of that will be sent out to external liquidity pools where it washes its face and earns a yield. And we send that back to the makers, again, minus a clip, which then heads into potential capital reserve. I'll come to that later. But when you come back to that kind of concept of being reactionary in your kind of trading, you're swapping in and out, that doesn't work. So the protocol treats it more like looking at an aggregator ledger. It looks at the aggregated position in the pool. It has a bunch of ratios that it needs to look at between the pool and the reserve and liability, asset to reserve ratios, reserve to liability ratios, all kinds of different kind of parameters that it looks at. And they need to meet a minimum standard, a minimum level. And so if that drops below in any of those parameters, then effectively the protocol is out of balance. So it then kicks in a bunch of balancing mechanisms to bring that back in line. And that means that the pool can meet any liability of the reserve can meet any liability of the pool. So if it's out of balance, we go through a few different kind of ways to rebalance. And one of the primary ones is the fee yield. This is a first order dynamic incentive-based mechanism. So this is essentially the premiums. They're dynamic, they change based on a bunch of variables, i.e. the historic underlying asset, the actual asset in the market in real time, how it's performing, and how far away your price is from your protected price on the downside. So that will increase the premiums, that incentivizes makers to come into the protocol because they can earn more yield, and disincentivizes the asset pool, the takers. So then we have bump distribution. This is a kind of daily standard distribution to takers and makers, starting off at kind of 50-50 of that availability, and then we put that on seesaw mechanism. So we can adjust that accordingly to who we need to actually come in and support the protocol to help rebalance. Then we have the auxiliary mechanisms, which are like arbitrage bots. The contract will be open to arbitrageurs, taking those opportunities to help rebalance the protocol. And if worse comes to worse, we have a community permissioned where we can actually do a kind of manual trade to rebalance. that works very well. But what needs to be clear is that, essentially an asset drop is not just a drop; it's a drop over time. So it's about a devalue, but over time. Things that drop, within an hour and then bounce back over 12 hours has a lot less effect than something that would drop 40, 50% and then just flatline for the next month. So assuming that kind of scenario happens, there might be a kind of deficit sitting in the reserve where the reserve isn't able to be, the protocol hasn't been rebalanced and the reserve has an amount that it can't meet, an obligation it can't meet. So then we run that deficit down through these risk tranches, and these risk tranches are supported by different makers with different risk appetites. They'll earn different levels of yield, but they will take on, higher risk, the higher yield. So essentially, we run that down through the tranches, and if the protocol hasn't had the time to rebalance by that point, then we kick in the Prudential Capital Reserve, which is essentially a big wad of cash that then tops up those reserves and brings it back up to balance. If for some reason Prudential Capital Reserve doesn't have enough in it, and we're working on ways to kind of front load that and make sure that it's capitalized right from the word go, then that's when the makers will take a haircut, and they'll take it in order of who took on the most risk. So it's something that essentially is taking risk. We understand risk. We distribute it and manage it in a very kind of clever way, and then we backstop it with a kind of fail-safe. And that's pretty much how it works.
Great. Okay. Thank you for the explanation, and hopefully people have taken a look through the schematic on screen as well. So with any new market, liquidity is key, is critical. You mentioned obviously the asset pool of ETH there. Are you just focusing primarily on the most liquid crypto assets to begin with, to ensure underlying liquidity and to attract a greater pool of liquidity providers? But is it ultimately designed to be able to support any underlying crypto asset?
Yeah, to begin with, the product's going to launch with ETH and USDC, right, as the counterbalancing areas. Yeah. The protocol's going to manage that risk for. The beauty of the bumper really is it's just expandable, right, to any asset class you want to kind of throw into it. Mm-hmm. So in release 2, we'll be expanding that into wrapped Bitcoin, Ren Bitcoin, the large ERC20 tokens on the unstable asset side, and then multi-denominated stable coins on the other side, so USDC, USDT, DAI, so forth. I think there's some quite clever things we can do there where the stable coin would all be in one massive pool, and that would be balancing lots of little pools of unstable assets. Some quite clever things that we can do there. Then when you get into kind of release 3, and I think this is where we're really trying to kind of push the capabilities of the protocol, right? And you can then start to put in things like bumpered coin, as in equity stocks of Coinbase, or bumpered Tesla, right, that have been tokenized. We can then kind of add a protection layer onto that. And we're putting into the plans now for a regulated version of bumper that would be accessible by institutions like Tesla that hold crypto on their treasury, and they have a fiduciary duty to take a hedge on that. So this would allow them to kind of operate in a way where it's completely KYC'd entrance on both the taker and the maker side. But the view of the kind of senior management team is we haven't scratched the surface yet of how far this can go, right? And the idea that you could take your property and tokenize it, and then you could bumper protect the price of your property, right, is something that bumper could quite easily kind of adapt to. So I think what we're seeing is the invention of a new type of instrument that deals really efficiently with risk, and we know that's going to fly in DeFi. The question really is like, how far can that extend out into traditional finance and start to kind of offer utility there too?
Yeah, and I guess some of these things, I mean, with these visions that I guess we all share of where this could all go, we're also frustratingly constrained by realities and limitations of the technology right now. Obviously, things like scaling, speed, bringing fees down is critical to everyone building within this ecosystem. But you mentioned things like KYC there. Maybe a few years ago you'd have been kind of hung, drawn, and quartered if you'd mentioned the idea of bringing kind of KYC into Bitcoin world. It's against the kind of whole ethos of it. But I think it seems within the DeFi vertical, everyone kind of appreciates that maybe there needs to be optionality around that. And if you're going to bring in a broad audience, these things are going to need to be available. What's given your kind of ringside seat? A lot of the developments going on. What are the main things you're keeping your eye on, which are interesting you most to help tackle that scalability? And are you working with other people more broadly in the industry about looking at this whole KYC problem? So there's kind of standard set that you can open up the markets together.
Yeah, so there's a lot to unpack there. The first thing to say is that Index reports into a task force that then acts as in an advisory committee to FATF, which is the kind of global regulator that it really kind of sets the guidelines for individual countries, right? And clearly, regulation is something that FATF is looking at DeFi and trying to understand, kind of how it can bring in measures that makes it a little bit more kind of robust, right? Index comes from a history of being very respectful and grown up about regulation, right? And at the moment, DeFi being trustless, permissionless, and non-custodial is great for its kind of frictionlessness, but if you want to start to target some of that kind of the bigger monies, bigger equity, bigger pools of money, then a blend of regulation is going to be required for specifically, the travel rule, for instance, which is one of FATF's kind of regulations. It all sits under something called VASP, Digital Asset Service Providers. And we're not adverse, obviously, to kind of making sure that we kind of follow those guidelines as it comes in. I think the separate question you asked there is what we're kind of looking at in that kind of ringside seat. And I can't speak for Gareth, obviously, because it comes down to personal interest. I'm personally fascinated by the dark forest, mempools, front running, and arbitrage, which is this kind of murky world where if an entity executes a trade that results in a profit, then it is possible for a bot to be scanning that, to see that, to copy that, and then to front run itself in the mempool so that it benefits from the profit in that. And that is just a fascinating kind of underbelly of DeFi. Yeah, I agree. Been reading up lots on it, and something we definitely want to cover on our Coinscrum market show as well soon. Gareth, what about you? What's in terms of what else is out there, what's being developed, what you think will support what you're developing? Yeah, I mean, obviously we're keeping an eye on like L2 solutions. That's something that we need to look at incorporating in our roadmap, and hopefully in kind of by the end of the year or kind of early next year, it's going to be kind of better solutions, a bit more grown up and better understood, and hopefully we can kind of implement that in our kind of second major release. But outside of that, it's just a general kind of look at I find same thing with the kind of mempools and all that kind of stuff. Really, dark forest stuff's all really interesting, and what's happening with NFTs is pretty fascinating and somewhat hard to get your head around sometimes about where value lies and whatnot. So I think there's a lot of interesting stuff there, but it's to be honest, I've been absolutely just buried in Bumper for so long that I just don't get to kind of poke my head out much anymore. So yeah, we all know that feeling. So Jonathan, you were speaking about kind of various different release versions scheduled going forward. Where are you actually at in terms of development, in terms of your funding? Have you been self-funding now? Have you raised external finance? And what's on kind of your roadmap over the next 6 months? What should people be looking out for? Yeah, we're pretty clear roadmap. Having come out of a 9-month scoping and design phase to design Bumper, right? We really took that to the next level. We worked out graphically what the DApp would look like. We worked through a lot of the mathematical curves that are going to govern Bumper. And so by the time that we came to pitch this to investors, which is in early March, we'd probably over-delivered, to be honest. And so our very first pitch, we were looking to raise, maybe five or six VCs, get kind of 50 to 100,000 off each one. We raised 500,000 off the first VC, and that just kept happening with every VC that we pitched to. So by the end of the month, we had closed just over $10 million worth of funding. We declined a further 32 million. So we're well capitalized, and we're feeling obviously that there's a massive market appetite for this. Our roadmap is looking pretty structured. So on June the 8th, we'll be delivering the first smart contract, which governs the right-hand side of that schematic. So everything to do with the makers of protection. That then also allows us to allow people to deposit USDC into the protocol to bootstrap. They will receive the bump token as a bonus reward for that liquidity, and only LPs that deposited will be eligible to partake in a pre-sale, where they'll be able to convert some of that USDC to the bump token at whatever that pre-sale price is. We're then kind of heading into a public sale in mid-August, and following that, we'll be then launching the full protocol in its entirety at the end of August. That then kind of gives us a working protocol that allows people to take protection, makers to earn yields, gives us the ability to kind of just tweak the protocol and kind of make sure it's kind of tailored to the wild. And in the background, the team will then get cracking on release 2. So we're straight into that kind of interoperability expansion out of the different asset classes. And that will be delivered around about Q4 this year. So it's all systems go at the moment.
Okay, great. So, as we look more broadly within the whole industry as well, there's lots of opportunity, but before we touch on those, there's also the risks that we need to touch on, because it's, especially these markets do sometimes feel like the Wild West. They're not without risks. What do you think in general the biggest risks across the DeFi sector are?
Certainly from my perspective, 2020 was really kind of characterized as, the flint and spark beginning of, what we now see as a kind of slightly more emerged and defined DeFi protocol and ecosystem. And clearly the biggest risk there was kind of smart contract hacks, right? Which again, using, things like flash loans, so quite kind of specific, quirky aspects of DeFi that then were able to be leveraged to exploit code that was maybe just a little bit lazily written that would allow a hacker to see an exploit that could basically drain out huge sums of money. And I don't know what the total sum that was extracted last year, but it was in the tens of, possibly even in the hundreds of millions of USD. So I think there certainly needs to be much tighter rigor around how DeFi protocols are kind of sense checked, certainly from our perspective, right? We've got two totally different independent companies doing very thorough smart audit contracts because we want to have that belt and braces kind of measure. But there's certainly a risk vector there. And I suppose the other kind of always prevalent risk vector in cryptocurrencies is regulation, right? We'll always need to see how far those established power structures feel that they need to put in mechanisms, and just how blunt those mechanisms are. That's the main risk vector, my concern is with something like DeFi is that they might come in a very heavy-handed, clumsy way to try to regulate it that stymies it, and I really hope that doesn't happen.
Yeah, well, I guess it's the opportunity there, and we'll come on to maybe broader opportunities, but it's the industry. I sense that people working and putting lots of time and effort into this know where the problems are. They know where they're possibly going to be blindsided by regulators, and they know they need to be thinking ahead. You mentioned the travel rule earlier in the discussion, and once that became up as a known issue, or was going to become a known issue, then there's a number of projects working on solutions around that. I saw some announcements last week with I think Luno were experimenting with a couple of other exchanges as well about a product which allows them to comply with the travel rule. So, as long as the industry stays ahead of the regulators and shows that not only can it come up with solutions to satisfy them, hopefully improve on what currently exists in the traditional markets, because I guess in principle that's what this industry should be able to do, and hopefully in the long term bring down some of those regulations, because I don't think the financial services industry can take any more regulations to sort of suffocating on it. And so I think it's time for our industry to prove that it can start addressing some of those problems in more creative ways.
100%. Yeah, and also I'm quite, we have this experience with index and dealing with regulations, and what kind of became apparent to me is that there's an aspect of regulation that is really there to protect consumers, but more often than not, it's actually a prevention for the consumer of opportunity. And so it kind of drives the general financial opportunity into the hands of the few. And DeFi is a beautiful example of something that could allow the very opposite. And the problem when regulation comes in, if it's not sensitive to that point, it will quash that ability for your average consumer to, I guess, step out from that regulation blanket that they've always been put under and actually take the opportunities that are actually available.
Yeah. Well, I think the industry has been making a good job at engaging with regulators, forming associations to tackle and to directly deal with them. Both, I know, in Europe, the NAPA group here at Crypto UK, the UK have been doing a great job, and it seems in the US that there's a lot of movement of former regulators or authorities getting positions at leading crypto companies as well. So hopefully that mix disseminates the understanding across both sides and will lead to good results. So I think that they are clearly some of the obvious risks, but let's finish more positively. Looking forward, what are the biggest opportunities again that you and the industry has in the years ahead?
I think there are three things that are kind of on my radar, and gosh, look how far DeFi has come in a year. Can you imagine the kind of exotic instruments and protocols we're going to have in, say, 5 years, right? With this level of innovation, if that can be sustained, it's just going to be an absolute hotbed. And I think that the kind of key investment thesis for me is that when you kind of take a macro view, right, that you have kind of fintech has kind of automated around the perimeter of traditional finance and just made it a little bit easier to kind of interact with it. Fundamentally, it hasn't done anything more than that. What DeFi promises to do is just eat traditional finance from the inside out and just absolutely replicate it. So the opportunities in that context is if you look at things like central bank digital currencies that could act as just a turbocharger for this DeFi ecosystem, but all of a sudden now you have huge amounts of kind of traditional fiat money that is now compatible with your DeFi ecosystem. That is just going to absolutely make the whole thing explode. There's an opportunity, I think, around the kind of the metaverse and the kind of essentially a kind of matrix type parallel of the world that we have right now, and how that kind of financial ecosystem will kind of just obviously be adopted by that. I think they're the kind of main two areas I think that just really excite me.
Yeah, I think probably quite a few things, or enough for everyone to get their teeth into. I think we can see it heading in that direction. So if people want to find out a little bit more, where do they need to go? And if you're looking to grow your team as well, if people are interested in perhaps working and contributing to Bumper, is there a way for them to do that as well?
Yeah, for sure. Well, bumper.fi is the website that has all the information that kind of allows people to kind of participate. I think one of the things that we're really keen with Bumper is to kind of onboard exceptional talent. And at the moment we have, pure mathematic postgrads, university economic professors, Swiss economists, as well as our own team and the engineering team. But we are particularly interested in a really kind of high level operations person to come in to kind of help with the full amount of delivery that we've got. And also social media is obviously a key kind of element for us. So we're looking to kind of make those placements there. But I think the key opportunity for most of the audience that come via you really is the ability to deposit that USDC from June the 8th and be first in the queue to earn bump tokens and then qualify for the pre-sale. Guys,
it's been a real pleasure hearing about the project and what you have on your roadmap. Really looking forward to see how this pans out. These are critical elements that will benefit the whole DeFi market in general going forward. So it's all fascinating stuff, and great to see you guys working on this. Thanks for joining us.